What's up, guys? Welcome back to the channel. Today I want to talk about real trading edge development. And if you've not been making money with trading and if you've been struggling with finding a strategy that actually works, this video will give you an example and it will give you tips on how to build your own strategy the right way and how to find this winning strategy. So without further ado, let's get started. Stick till the end because at the end I will give you those tips. Right, so I quickly want to share this certificate that I just received. Another funded account for me. I really want to focus the coming months on getting more funded accounts, stacking up my capital for myself, as well as the people I've been mentoring in the past, getting them funded. I just want to quickly share this with you and also to motivate you guys that if you follow the steps I'm going to share with you, and if you follow what you need to be doing, and if you follow your plan, and if you stick to it, you can also become a funded trader in the end. And that will open many doors. If you get a few funded accounts, you can get a decent income from trading. And it all starts with hard work. So I also tell people when they ask me like, how can I get more funds to trade with? And can I even get an income out of this? First, focus on becoming a profitable trader. Focus on getting that edge. The money then will follow. So yeah, stick to it, guys. If trading is really what you want to do, stick to it, work on it, ask questions, and you will get there. So let's dive into the topic of today's video. And today's video, I first want to start with explaining what is an edge, because most people just don't understand it, and it has to be really clear because otherwise you're all over the place. So an edge can come from a trading style that gives you a positive expectancy. This can be fundamental trading. This can be discretionary trading. This can be technical trading. This can be automated trading. Whatever it is, it has to be a trading style that gives you a positive expectancy. And a positive expectancy consists of win rate and average R. And that's really important because I see so many people online telling you that you need a 1-to-3 risk reward ratio or anything like that. And that's not true. If you win 70% of the time, a 1-to-1 win rate is a big edge. Like, you will have very consistent gains. You will have pretty low drawdowns if your win rate is that high. But on the other hand, if your win rate is only 40% and your risk to reward is 1-to-2, you also have an edge. So basically, there are many ways to edge. And it's all about that positive expectancy. And that's what you need to keep in mind as well with edge development. And later on, I will give you more tips about this. So let's start with a real example. Here on the screen, you can see some statistics of a project I've been working on in the past. Basically, trading a breakout strategy in indices. This is tested in the DAX market, the German DAX. And what you can see here on the top is 2,304 trades. And these are all different target styles. Below, you can find the equity curve of this strategy over this sample for 10 years. So this is a 10-year equity curve. And as you can see, it does look pretty decent. Now, keep in mind, this is with a 3-hour target, so 1-to-3. And the win rate there is 28%. So 28% win rate with a 1-to-3. And it's profitable. It has an edge. Now, this does not include trading costs, so there will be taking some shine off. Doesn't include slippage and all these things. But this is the basic idea. What I did is basically a breakout of the opening range in the DAX, testing it and gathering data, testing different targets to see, is the market likely to trend with a certain type of breakout, etc. I'm not really diving into detail there, but essentially what I did is I defined the trading range, so the first hour after the open in the DAX. So that's very clear. You cannot, it's not a gray area. So it has to be that clear. Then I defined what a breakout was. For me, it was a 15-minute close to either the high of that range or the low of that range. Then my stop would be on the other side of the range. And I just want to show you this so that you understand how clear it has to be if you want to develop an edge. It can't just be, yeah, I'm selling a double top. Make it more clear, make it more definable. The first hour of trading is clear. There's no debate about it. Everyone knows that. A 15-minute candle close through the boundary of that hourly range, there's no debate there. It's very clear. And you want to keep that in mind when you're developing your own edge. So this does look pretty decent. But then if you take a look at the graph, and especially this period right there, you can see that this strategy is in drawdown for around 600 trades. So basically we make a high and it takes around 600 trades before we make a new equity high. That's around 2 years of drawdown with this strategy. So that's really, really long. And although the equity curve does look good from, from what you can see here, a 2-year long drawdown obviously is not ideal. So this has to be optimized to maybe decrease the profitability, because it is quite profitable and I don't mind if it goes down in profitability, but I want to put the consistency up. But that's, a project that you can do later on, that I will be doing later on. The point is that you now know, okay, a basic example, I gave you basic rules on what I tested, gathering the data, and also when you are testing targets or testing, things, for example, the MFE, the MAE, to see how far price goes after a certain entry setup, keep in mind that it has to fit with your strategy. So if you trade a breakout of a trading range, your risk reward will naturally be lower. So to draw it on the screen, the way I trade is basically I want to see this pattern, and then I'm buying a retest, playing for the next leg, and I'm getting out. That's in a nutshell what my main swing strategy does. Obviously, this only capturing this part and entering that late will make sure that you're right more often, but it will also harm your risk reward. In the meantime, let's say you find a way to enter there, then this is your reward and your risk might be this small. So you have a bigger risk reward, but you will be wrong more often. And the point I'm trying to make is that in terms of picking targets, taking profits, that's a hard thing to do in terms of strategy development. Make sure that it fits with your strategy. When I trade like this, I'm not going to be like, yeah, I'm going to target somewhere up here for 1 to 10, because I know I'm quite late to the party, because I wait for the entire range, I wait for the breakout, I wait for the pullback. I'm a bit late to the party, and in turn, I get a higher win rate, but I also have to skew down the risk reward because there's not that much in it. Here, you're early to the party, so it makes sense to aim for a bigger target, and your win rate will be lower there. But that's what I want to tell you guys. Like, keep that in mind when you're developing a strategy, when you're testing things. It also has to make sense for your strategy and how the market behaves around the concepts that you use. So let's take a look at some actual tips that you can use. The first one, and I've said this before, is to keep it clean, keep it clear, keep it simple. What I just shared with you in the previous slide is a very simple strategy. Like, it doesn't, it's not complex. It's really easy to test. You write down 2 lines, this, and this. I'm going to enter here, exit there, etc. Very clean, very easy to test. There's no guesswork, there's no doubting, no gray areas. And that's what you want, especially with your initial testing. Because if your initial testing already needs 5 parameters for it to work, probably not the best thing to test. The next thing is make sure it's robust. Robustness is key. And what does it mean? First of all, it works on a long time horizon. So not 1 or 2 years, but 10 plus years. That's what you want to do. And it works in multiple markets that make sense for your strategy. For example, if you develop an opening range breakout strategy and it only works in the DAX and it doesn't work in the European stock index, so the Euro stocks, it doesn't work in the S&P, it doesn't work in the NASDAQ, but hey, it did work in the DAX. You probably don't have the most robust strategy because they all have opening ranges. And yes, the markets are a bit different, but they are also a bit similar in terms of they're all stock indices. So you want to see similar behavior across those markets. And if you only see it happen in one market and in the other 4 that you test, it doesn't work, strategy isn't that robust. Same with Forex. If you develop a strategy in the Forex market and you test 10 markets and only works in 2 or 3 and the other ones are losing, many people will be like, oh, I'm going to just trade those 3 markets and not trade the rest. But that's not really the best thing to do. It just tells you, okay, your strategy isn't that robust. It has worked over this period in that market, but not in the other ones. So you might just be cherry picking the best markets, and the next 5 years, those markets don't perform well and the edge is gone. So make it robust. Test it over a long period. Test it on multiple markets that make sense for the edge that you developed. That's really important. If you want to do specific optimization, use out of sample data. So quick basic example. If you're going to build a strategy using indicators, for example, the EMA, you want to build an EMA crossover trending strategy. What most people then do is they test the first parameters and they're like, oh, the 50 and the 20, the 50 and 200 work really, really well. And then, oh, I wonder what it's like if I put the 45 and the 190 EMA. And then, oh, this gives me better results. Yeah, because you're literally going in the data that you already used to find the best answer there. And that doesn't have any predictable power for the future. So if you're going to optimize parameters like that, you know, finding the best settings, you want to use out of sample data, preferably something called a walk forward analysis, which you can find anywhere on Google. If you Google it, walk forward analysis. I'm a big believer in that the basic edge that you test should be profitable somehow. And that optimization should only be done to maybe decrease the drawdowns a bit or something like that. But it shouldn't be done to make the edge profitable, in my opinion. That's just how I view it. I think if the basic idea already works, makes strategy more robust. So that's just some tips. One more thing, and this is a big mistake many people make, is that they want to build the perfect equity curve. So they got the curve and they want it to look like this. Obviously, that's never going to happen. And if you find something like this in your backtest and you trade live, it will probably go like that. If you see someone sharing an EA that creates this type of equity curve, run away, because it probably uses some type of martingale, some type of, you know, hedging, weird risk hedging, grid strategy, whatever it is. They use something that's not sustainable. Yes, it works in normal environments, but as soon as you get something like COVID and you get these big aggressive moves, boom, goes down. So be careful with that. You want to build handful of decent edges. So 5 strategies with, you know, all curves like this, you know, decent curves, and 5, 10, I don't know, multiple edges that are completely different that have curves like this. Because this tells you, okay, the strategy is probably simple if you kept to keeping it simple and not optimizing it too much. If you did optimize, you want to use out of sample data. But this tells you, okay, the strategy does have bad periods. But it also then, when it's not in line with the market, yes, it gives me this drawdown. But then it gets out of it. The strategy goes back in sync with the market. And that's really what you want to see. The strategy, while the markets are changing, the strategy being in drawdown, but not blowing up, staying there, going to the next high when it gets back in line with the market, etc., etc. You want to build decent edges, not that much optimized. And that's going to really help you to build that robust income from trading. So hopefully that helps you guys. If you have any more questions about this, comment down below, subscribe if you like this video, and then see you next time.